when you went from W-2 to self-employed, whether you called it 1099, freelance, consultant, solo business owner, you didn't just lose a paycheck. You lost a stack of invisible benefits your employer was building behind the scenes. Health insurance, dental, vision, group life insurance, long-term and short-term disability, and a 401k match. Sometimes you might have even had an HSA contribution or a flexible spending plan. Most of those weren't on your pay stub, however. They were in your benefits summary, which most of us only look at once a year during open enrollment. You never look at it otherwise. When you go solo, you have to rebuild that stack yourself. And most self-employed people I work with rebuilt one, maybe two layers, usually health insurance, and skip the rest. I'm Micah Brown. I'm insurance licensed in Michigan. Today I'm going to walk through the 5 layers of the self-employed insurance stack, the order to build them in, and the layers most solo earners skip until they cost them. What you actually lose when you go work for yourself. A typical mid-career W-2 benefits package is worth somewhere between 15 and 25% of your base salary in employer-paid benefits. That's the part that doesn't show up on your pay stub. Health insurance, life insurance, long-term disability, retirement match, and other items. When you went solo, your effective compensation didn't just drop by the salary you lost. It dropped by salary plus those benefits. Most solo earners price their work like W-2 earners, based on what they used to make, but they forgot to add back the benefits cost. That's how solo earners end up working harder for less total compensation than they had as employees. The stack matters not just for protection, it matters for pricing. Health insurance is the loudest layer because it's the most expensive and the most immediate. For self-employed people in Michigan, the main paths are the ACA Marketplace, a spouse's employer plan if available, COBRA from a former employer for up to 18 months, or in specific situations, a private market plan. The marketplace is the most default for solo earners without spousal coverage, with premium tax credits that scale with income. If you earn less, you pay less. Earn more, pay closer to retail. The trade-offs on networks, deductibles, and prescription formularies are real. For self-employed people earning significant income, the unsubsidized cost can run $12,000 to $20,000 a year for a family plan with reasonable deductibles. That's a number to plug into your pricing model. HSA eligible, high deductible plans pair with a health savings account that's triple tax advantage. Deductible going in, growth deferred, tax-free on medical expenses going out. Worth understanding regardless of which plan you pick. Next layer is on disability, and that's a layer that most people skip, but you really shouldn't. As a W-2 employee, your employer's long-term disability plan probably replaced 60 to 70% of your income if you couldn't work. As a solo earner, you have zero income protection unless you bought it yourself. Individual disability insurance pays a monthly benefit if you can't work due to injury or illness. Benefit periods are usually until age 65, and definitions of disability matter here. Whether it's own occupation means you're covered if you can't do your own specific work, or any occupation means you're only covered if you can't do anything. Premiums are real money, but the math is honest. If you have any meaningful income depending on you working, and you don't have a working spouse who could fully replace your income for years, this is one of the most important policies you don't have. The statistics on disability are uncomfortable. Your chance of being disabled for 90 days or more at some point in your working life is higher than your chance of dying during that same window. Most people insure against death and skip disability. Next is up is life insurance, and for self-employed earners, works the same way as W-2 employees, with one twist. There's no group policy from an employer doing some of the heavy lifting. Term insurance covers the income replacement need for the years dependents need your income. Permanent insurance covers longer-term legacy and business succession needs. The twist for self-employed people, your business may have value tied to your continued involvement. That value disappears when you do. Term insurance covers a family. A key person policy or appropriate business-owned policy covers a business value. Most solo business owners get the family side right and skip the business side. Next up is ancillary benefits like dental, vision, hearing, accident, hospital indemnity, critical illness, and a few others. These are smaller policies that fill specific gaps. Dental and vision are usually optional add-ons through the marketplace or standalone policies. Premiums are modest, And for families with kids and braces or members with eye conditions, the math can work. For young single solo owners with no significant dental or vision needs, the math doesn't always work. You may be better off funding routine care yourself. Accident, hospital indemnity, and critical illness policies are going to pay you a lump sum if specific events occurred. They're not health insurance. They're cash supplements designed to cover deductibles, time off, or out-of-pocket costs. For self-employed people with limited cash reserves, these can be reasonable additions. For self-employed individuals with adequate emergency funds, they're going to be redundant. Decide based on your cash position, not the brochure. And layer 5, lastly, is retirement. When you went solo, you lost the 401k match. You also gained options most W-2 employees don't have. The SEP IRA, Simple IRA, Solo 401k, and defined benefit plans for high-income solo earners all exist. The Solo 401k is usually the workhorse with high contribution limits, a Roth option, loan provisions, and similar tax treatment to W-2 401ks. For self-employed people earning meaningful income who can save aggressively, defined benefit plans can let you put away significantly more than any other tax advantage vehicle, sometimes hundreds of thousands of dollars a year or more, depending on your age and income. This isn't insurance, but it's part of the same conversation, replacing the benefit structure your employer used to handle. How do you go about building this, and in what order? So this is how I help my clients build their stack. Layer 1 is health insurance. On day 1, don't go a day without coverage. Next up is disability insurance. As soon as your income is meaningful and people depend on it, you don't want to wait for the gap to bite. Layer 3 is life insurance. If you have dependents, this one's non-negotiable. Up next, number 4 is for your retirement plan. The solo 401k for most, SEP for simpler setups. Lastly is ancillary coverage as your cash flow allows. Dental and vision first, critical illness and accident if the cash reserves are thin. This isn't 5 separate decisions. It's one stack built over the first 18 months of self-employment. 5 mistakes that I see. First one is pretty big, skipping disability insurance. It's the most common, and it's the most expensive when it matters most. Second mistake is over-insuring on life and under-insuring on health and disability. Death feels more viable. Income loss is quieter and more likely. 3 is picking the cheapest marketplace plan based on premium alone, then getting hit with the deductible the first time anything happens. Total cost matters, not just your monthly premium. Number 4 is forgetting that S-Corp owners and LLC members can deduct health insurance premiums above the line, subject to specific rules. Talk to your CPA about how to structure this correctly. Number 5 is not adjusting pricing to account for the new benefits cost. If you don't add the stack into your rates, you're absorbing it personally and pretending you're making what you used to make. So here's what I would do if I were going to solo tomorrow, all over again, in this order. Week 1, health insurance lined up before any coverage gap. Month 1, I'm looking for disability applied for because underwriting takes weeks. You need to start early. Month 2, a life insurance policy applied for if I have any dependents, which I do, and that's what I did. Month number 3, the solo 401k opened, the first contribution made. Month 6, ancillary coverage as cash flow allows. We'll keep it in place that accounts for the new benefits cost in that pricing. This isn't theoretical. This is the order I'd build the stack in if I were starting Legacy Financial Solutions over today. So that's 5 layers. One stack. The W-2 employer used to handle most of it for you. As a solo earner, you build it yourself or you don't have it. I built a free self-employed insurance stack guide that walks through the 5 layers, the order to build them, and the pricing math so you don't underprice your work. DM me the word solo on Instagram and I'll send it over.